So, Nick, thank you very much for joining me today. How are you doing?
Very well, thank you. Good morning. Nice to see you.
Nice to see you too. So let's set the scene. Let's go straight into it. So we know that the global goal is to achieve net zero by 2050, but how do you see the role of financial institutions in achieving this?
So achieving net zero by 2050 is going to be an enormous challenge. It is going to involve rebuilding the world's energy system far, far faster than it has ever changed in over 200 years of human history. And we know that the success or failure of that building project is going to come down in no small part to a question of capital allocation. The energy system is hugely capital intensive, consuming at least $10 trillion, that the listed energy part of it alone, of investors' capital. And we know that rebuilding it in that rapid a period of time, along with premature write-off of existing capital assets, is going to require the deployment of somewhere between 30 and $50 trillion on a net basis, depending on whose numbers and analysis you believe, over a 30-year time horizon. In other words, above all, this is a question of capital allocation. And in that context, the role of financial institutions, we are the capital deployers, the capital stewards of the world, is absolutely vital.
And I think earlier this year, we were talking about greenwashing and recognizing greenwashing quite early on. How have these challenges been addressed since, and are they still a concern, especially with financial institutions looking to allocate their capital correctly and in line with the business?
So greenwashing is a concern. It's a concern for us as a financial institution. We want to be very careful that we are making sure that everything that we claim to be doing, we are really doing, and we are giving an honest representation to the outside world of what we're doing, because we are trying to assess, as you've said, the extent to which the institutions to whom we are providing capital are doing the same thing. Unfortunately, when we look at the world of investable companies, we see a world where there are a number of companies making claims that are at least a little bit stretched relative to reality. We see that in a number of places, one of which tends to be around timing. So we see a lot of companies making big, bold net zero plans where all of the work is done a long, long way in the future. And we see companies making big, bold plans that are stated in such a way as to be very convenient for them, given the precise nature of the assets and the business model and the business plan that they already have. So we think investors, capital allocators, risk professionals need to look at the statements and targets that companies make with a critical eye, because we need to risk adjust those promises on the basis of the evidence that we actually see in front of us. We think a really, really good starting point is to say, okay, we're going to listen to the promises that you're making, but we are going to look really carefully first at what you have actually been doing. And we're going to listen to what the companies are doing before we listen to what they say, and make sure that what they say about their future actions is being backed up with tangible evidence of change that is occurring today.
That is a huge responsibility for any risk manager or anybody dealing with all this. But of course, the other thing that has come in this year is the regulations around the stress testing and climate risk reporting. What's the industry's reaction to them, and what's next on the regulatory roadmap, especially next year?
So I've no visibility into the regulatory roadmap of the future, but I would not at all be surprised if we continue to see rising regulatory scrutiny on the extent to which risk modeling exercises are becoming genuinely integrated into capital allocation decisions. We know that climate risk is a very, very difficult thing to price. We know that there is huge modeling uncertainty, scenario uncertainty, and outcome uncertainty. In other words, we don't know what climate outcome the world is going to realize. We don't really have a very good way of assigning probabilities to different outcomes. Unfortunately, as time marches on, the probability that we should be assigning to 1.5 net zero outcomes, the outcome that we want to be our base case, is shrinking as the clock ticks. It's a very unfortunate, very unpleasant outcome for us, is that we continue to reduce, I think, the probability associated with the world actually realizing the one outcome that we want it to realize. But you don't know what outcome we're going to get. We don't know which pathway to that outcome we're likely to be on. And we don't know, given the ranges of modeling uncertainty, whether model A is better than model B or better than model C in terms of accurately understanding what those risks are likely to be. So in that context, what can you do? I think you can work really carefully as risk modelers to make sure that we build models and we build modeling approaches that are transparent, that we build glass boxes, not black boxes. We make sure that we build models that, along with being transparent, are not chasing after spurious precision. We're not trying to overly precisely specify things to create the impression of more resolution and certainty in the modeling process than is really there. And then we need to make sure, probably most importantly of all, these are not numbers which are produced to look good to the outside world, whether that's a regulator, an investor, or any other sort of stakeholder, but that climate risk genuinely gets embedded into real capital allocation decisions. And that's really important for two reasons. One, because it's going to drive real changes in the way capital is allocated, but also because I genuinely believe that as you engage real capital allocators, and my background is as a fund manager, not as a risk professional, with the analysis, so all of the mistakes that we are making, and we should be absolutely clear that climate risk modelers are making lots and lots of mistakes, that all of the mistakes that we're making, the modeling inaccuracies, the erroneous assumptions, the leaps that we make in the processes, these will get unpicked in a much more effective way, and we will get much, much better at this job the more real capital allocators engage up close with the models and with the outcome.
Certainly. And going into 2022, will this be one of the key challenges in further developing businesses' sustainable strategy? How do you see that sort of going forward?
Yeah, I agree. I think over the next 12 months, we're going to grapple with a bunch of things. One of the things we're going to grapple with is probably, unfortunately, an emerging understanding of a serious energy shortage that the world appears to be facing. We've seen the supply side of the old world contract pretty aggressively. We've seen capital spending plans of listed oil and gas companies, for example, coming down very fast. Now probably either close to or in alignment with where you would expect to see those CapEx plans in a net zero type of energy outcome, whilst at the same time not seeing anywhere like the increase in capital spending that we would need to see in the new part of the energy system. And that is leaving us with this emerging energy shortage, which, if something doesn't start to change, could end up with some very, very nasty economic outcomes, and very nasty outcomes for consumers, and very nasty outcomes in particular for the world's poorest, very nasty outcomes for us as investors. So that's problem number one, is I think we're going to have to start grappling as risk people with an understanding that uncertainty about the future climate outcome that the world is going to realize is going to start feeding through today into greater volatility and uncertainty about the energy system and energy pricing over the near term as well as over the long term. The second challenge, I think, is this challenge of integration, really integrating this emerging discipline of climate risk analysis into capital allocation processes, and demonstrating that we are really doing that as financial institutions with the outside world. The last challenge that I anticipate in the next 12 to 24 months is to see more and more companies, as climate risk gets embedded into capital allocation decision making, so companies are going to start to want to engage in a much more involved way to improve their understanding of how we are assessing them from a climate risk perspective. And that, I think, is also going to substantially increase the pressure on climate risk analysis teams to make sure that we really are doing a good job of this, because companies are going to start pushing back, and potentially pushing back really quite hard against the way our models are working.
Absolutely. Nick, thank you very much for joining me for this quick chat. We could probably be talking about this all day, but I'm going to let you go now.
Okay. Thanks very much. Really enjoyed it. Have a great day. Bye-bye.